Hello, this is Dr. Kara Nunez. Welcome to the Chapter 14 problem solving session. Well, let's get started with our first exercise. We're going to be looking first at horizontal analysis in basic exercise 14-1. So in a horizontal analysis, we are measuring relationships across time. So in this case, we're measuring relationships for these two variables, accounts payable and long-term debt, from the previous year to the current year. So I've got the information set up down here in a table format. So the current year and the previous year, just the information that we're given. And we need to do two things. We need to be able to measure the amount of the increase or decrease. That's this column here. And then the percentage of increase or decrease. That's what you typically show in a horizontal analysis. So let's see, the amount of the increase or decrease is just the difference between these two numbers. That's all we need, is the difference between those two numbers. So let's see, we've got 116,280 minus $102,000. That is exactly $14,280. So all we're doing is we are taking the difference between those two numbers. And I will put the actual calculation right here in this cell. Right, so 116,280 minus $102,000 gives us the 14,280. That's the amount of the increase. And same thing for long-term debt. We want to know the amount of the increase or decrease, the difference between those two numbers. So 129,600 minus 120,000 gives us $9,600. That's the amount of the increase. And again, all we're doing is taking the difference between those two numbers. So again, I'll put the calculation here. Next, we need to know what percentage those numbers represent. What percentage is 14,280 in terms of an increase? So when we calculate the percentage increase, all we're doing is we are expressing this number, 14,280, as a percent of what is called the base year or the previous year, 102,000. So let's see, I think, do all of that in just one copy and paste. So in this case, here we are. It represents a 14% increase. Again, all we're doing is we're taking that 14,280 and dividing it by $102,000. So we're taking this increase and expressing it as a percent of the previous year, which is the base year, $102,000. So 14,280 divided by 102,000 is a 14% increase. So we know that the change in accounts payable, right, using this horizontal analysis, the change is an increase of $14,280 over the previous year, and that represents a 14% increase over the previous year. And we want to do the same thing for the long-term debt. We want to know what percentage increase that $9,600 is. So all we're doing here is we are expressing that as a percent. That $9,600 divided by 120,000 is an 8% increase. And that's a horizontal analysis. And we can do that for any item in the financial statements, right? Any item on the balance sheet, any item on the income statement, any item on a retained earnings statement or a statement of stockholders' equity, we can do it for any two measures, right? If we have a current year and a previous year, or we can have a current year and 2 years ago. We can measure any amount of increase or decrease in a percentage format or in a dollar format, as long as we have those two variables that we're taking the difference between. So that's our horizontal analysis, first exercise. Let's move on and look at the vertical analysis in exercise 14.2, BE 14.2. So a vertical analysis, now what we're doing is we're looking at the variables, in this case, just on this income statement. A partial income statement is what it is, because you only have 3 line items from the income statement. We're looking at a vertical analysis, which expresses the line items on the financial statement or any other statement as a percent of some base amount. So we're not looking at relationships over time. We're looking at relationships in terms of some base amount. And whenever we do a vertical analysis on the income statement, the base is always sales, right? So the base variable, right? I want to identify that. Our base variable is always going to be sales. We always establish sales as the base, which means everything on the vertical analysis is going to be expressed as a percent of sales. Everything gets expressed as a percent of sales. So if the base is sales, then all we're doing here is expressing sales as a percent of sales, right? Every line item gets expressed as a percent of the base amount. The denominator for all of these calculations is going to be sales, 1.5 million. And 1.5 million over 1.5 million is 100%. That's our base. The base is always 100%. Now, we also want to know what percentage the cost of goods sold is of our sales. Again, the denominator for all these calculations is just going to be sales. So we want the $900,000 divided by sales. Cost of goods sold is 60% of our sales. That's what that tells us. We are expressing every line item as a percent of sales, a percent of the base amount. Same thing with gross profit. We want to express that gross profit as a percent of sales. So what this tells us is that our gross profit is 40% of our sales. 600,000 divided by 1.5 million. That's a vertical analysis. And we would continue in that fashion for every single line item on the income statement, right? If we had the whole income statement from the top, sales, down to the bottom, net income, we would just do the same thing, express every line item, in this case, as a percent of $1.5 million. That's a vertical analysis. Now, let's switch gears and look at ratio analysis. That's the other type of analysis that we introduced in this chapter, right? We looked at analysis in the form of a horizontal analysis, vertical analysis, and now let's move to ratio analysis. And we're going to look first at current position analysis, which will tell us something about liquidity, the ability to pay our maturing obligations in the short term, those current liabilities. So the two key ratios that we look at in terms of liquidity analysis is the current ratio and the quick ratio. Again, these ratios tell us something about our ability to meet those maturing obligations in the short term or the current liabilities. So the current ratio is very simply all of the current assets over all of the current liabilities. That's all we need. All the current assets over all of the current liabilities. Well, I think I've got the current assets summarized at the bottom here. So all the current assets I've summarized here so that we have a subtotal, right? The current assets consist of the cash, the marketable securities, the accounts receivable, the inventory, right? It's those first four line items that we're given. All of these represent the current assets. So if I can just highlight what I've done, all of these represent those current assets, right? Those current assets I've summarized and put the total down at the bottom. All of these current assets sum to a total of $729,600. $729,600. And our current liabilities, well, we only have one. Accounts payable is the only current liability we have. So we've got the denominator, right? It's given $228,000 of current liabilities, and the current assets I added at the bottom, right? All of those four numbers I bracketed are 729,600. So the current assets divided by the current liabilities gives us the current ratio, which equals 3.2. And it does say to round to one decimal. There's our rounding to one decimal. So the current ratio is 3.2. What does that tell us? It tells us for every dollar we have in current liabilities, we have $3.2 in current assets. So we can more than pay our current liabilities. In fact, we have more than enough, right? We have $2.20 more than our current liabilities. right? Because our current liabilities at a dollar, we'd have $3.20 to pay those current liabilities. So we have more than enough. Certainly, if this ratio is, if it dips below 1, that's a danger zone, right? That's a danger zone for all industries. So you certainly want to have enough current assets to pay your current liabilities. And a good ratio is going to vary from company to company, but at least we know, excuse me, in this case, we have more than enough current assets to meet those current liabilities. The current ratio is 3.2. The other ratio that we want to look at is the quick ratio. The quick ratio, like the current ratio, tells us something about the ability to meet those current liabilities, those currently maturing obligations. But it doesn't use all of the current assets. It only uses the quick assets, or the assets that we could quickly liquidate. That means that we want to exclude those things that would take us a little bit longer to liquidate, like inventory. So when we look at the quick ratio, we want quick assets, which should not include inventory. So down below here, I've got the quick assets. The quick assets, when you take that inventory out, it's just the cash, the marketable securities, and accounts receivable. So the quick assets are only $602,600, $602,600. So we're going to measure this quick ratio using in our numerator those quick assets over those current liabilities. And again, the current liabilities haven't changed. We only have one, and the current liabilities, or the accounts payable, are still the $228,000. Same denominator we had up here. So what does the quick ratio equal? It's 2.6. So that tells us that we don't have quite as favorable a ratio when we just look at the quick assets, because now, given $1 in current liabilities, we only have $2.6 in quick assets, but we still have more than enough to pay those current liabilities. That's what these two ratios tell us. So the current ratio and the quick ratio. Next, let's move on and take a look at, in this case, same thing. Exercise 4, I'm sorry, 14-4. That was 14-3. And in 14-4, we're going to continue to look at liquidity, but now we're going to look at the receivables. So we're going to look at the receivables, and then we'll come back and we'll look at inventory as well. But these are all measures of liquidity that tell us something about the ability to meet those maturing obligations. So the two receivables ratios that we look at in this chapter are the turnover and the days sales. So the turnover is very simply sales over the average accounts receivable. So we just want to take that sales number that we're given, the 5,250,000, and we want to divide into that the average accounts receivable. And that will give us this measure that we refer to as the accounts receivable turnover. And the measure is 15. So the ratio that we have for the turnover is 15. And what does that tell us? It tells us the number of times that we collect on our receivables. So 15 times, right? You make a sale, and on average, our accounts receivable is $350,000. So on average, it takes us 15 times during the year to collect on the average balance of receivables, which is $350,000. So on average, we do that. We run through, or we turn over our receivables 15 times during the year and collect on them. And this is the kind of ratio that you'd want to compare to industry averages. You'd want to compare to prior years or prior periods to get some sense for how you're performing versus in the past, or versus some kind of an industry benchmark. Another measure that I think is sometimes just as telling, or even more telling, is the days sales in receivable. The days sales in receivables, it tells us the same kind of information, but we calculate it just a little bit differently. So in this case, the denominator from the receivable turnover measure is the numerator in the days sales. So we need, again, that $350,000. That is the average accounts receivable. So there it is. And we want to divide in that what we call the average daily sales. So on average, what are our sales? Well, the average sales, it's just sales divided by 365. That's all we need. Sales divided by 365. And what are the sales? Well, the sales are 5,250,000. We have those right there. Sales are 5,250,000. So we want to take those sales and find out what sales are on average. What are the sales average on a daily basis? Well, the 5,250,000 divided by 365, on average, we've got sales that are 14,385. That's what this tells us. On average, the sales are 14,384 per day, right? Given our total sales of 5,250,000 and 365 days in a year, on average, we sell $14,385 worth of sales on a given day. You want to divide that into the average accounts receivable, and that will tell us the day's sales in receivables, or said another way, the amount of days that it takes to kind of sell through those or collect on those receivables. And that is 24.3. Right. So essentially what we're doing is we're saying, we turn that receivables over 15 times, and it takes us 24 days to do it, 24.3 days to do it, given what the average sales are. It takes us roughly 24.3 days to turn over those receivables. Okay. So again, both measures are very important in terms of telling us how liquid those receivables are, how quickly we collect on them, and how long it takes to collect on them. Okay. Now let's move on and do the same kinds of things for in this case inventory. Right. Let's look at that inventory. That's another key measure of liquidity. Right. We want to make sure we understand how long it takes to sell the inventory, and how many days does it take to sell that inventory? How many times do we turn that inventory over? And that's exercise 14-5. And there are two measures we look at here: inventory turnover and the days sales in inventory. So the inventory turnover, very simply, what that is the cost of goods sold divided by the average inventory. So that cost of goods sold measure that they give us, the $696,000, and we want to divide that average inventory into that, and that will tell us the inventory turnover, or the number of times that we are able to, turn over or sell that inventory during the year. So given that on average we have inventory of $58,000, and given our total cost of goods sold of $696,000, that would mean 12 times throughout the year, we sell through that inventory and replenish it, right? 12 times a year, we sell it and we replenish. We sell, we replenish. We do that 12 times. That's what that inventory turnover measure tells us. Now, we also want to know, well, how many days, how many days does it take us to do that? How many days sales do we have in that inventory? So we want to take that average inventory, if you will, that $58,000. We want to take that and make that now the numerator here in the day sales in inventory. And we want to divide that by the average cost of goods sold. Well, how do we get an average cost of goods sold? Well, the average cost of goods sold is just cost of goods sold divided by 365, right? We just want to divide that 365 days into the 696. So on average, what we know here is that our cost of goods sold is about 1907 per day, right? That's on average what we're selling in terms of costs for the inventory. On average, we sell goods that cost us $1,907 a day. And if we divide that into our inventory, what that tells us is we're actually selling that inventory over, 30.4 times. right? Given the sales per day and the average inventory, that we're selling through that inventory 30.4 times. So we do it 12 times a year, and it takes 30.4 days to do it. Okay. So again, those are two key measures in terms of liquidity with respect to the inventory. Let's go back to ratio analysis in general. So there are three categories that we look at when we do a ratio analysis. We look at liquidity, we look at solvency, and we look at profitability. So liquidity tells us about our ability to pay our maturing obligations in the near term, those current liabilities. Solvency tells us about the ability to meet those long-term obligations, and profitability tells us about our ability to generate earnings or profits. So let's look at the second one, the solvency analysis. And there are two measures that we look at in this chapter that relate to solvency. We look at the ratio of fixed assets to long-term liabilities and the ratio of liabilities to stockholders' equity. So all we're doing here is we're putting the fixed assets over the long-term liabilities to see that ratio, right? So the fixed assets over those long-term liabilities. So we've got, 1,176 in assets, those fixed assets, and we've got liabilities of $280,000. So what that means is we've got a ratio of 4.2 to 1. So for every dollar we have in long-term liabilities, we got $4.2 in fixed assets. That's what that ratio tells us. It's the ratio of assets, fixed assets, to long-term debt, if you will. That's what long-term liabilities represent. Long-term debt that is due beyond a year. It's not due in the current year, it's due after a year. So we have, for every dollar we have in long-term liabilities or long-term debt, we've got $4.2 in fixed assets. And obviously, more is always better. You want to have as much as you can in fixed assets to be able to cover those long-term liabilities. And then the second measure we look at is the ratio of liabilities to equity, the ratio of total liabilities to total stockholders' equity. So these last two numbers, total liabilities to total stockholders' equity. So we want to put those total liabilities in the numerator, and we want to divide by the total stockholders' equity, which is that $320,000. So what we're saying is the ratio here is 3 to 1. All right, for every dollar we have in equity, we got $3 in liabilities. For every dollar in equity, we have $3 in liabilities. So it's basically a ratio of investors, if you will, because we have stock investors that have given us 320,000. We've got creditors that have invested 960,000. Credit is an investment in the business, right? It doesn't yield dividends, it yields interest, but it's still a type of an investment in the business. So equity investors have 320,000 and liabilities are 9.6. So we've got a 3 to 1 ratio. So less is better here. You want to, as much as you can, limit the amount of debt that you have to your equity. You want to minimize that risk to your shareholders. So those are the key measures that we look at in terms of solvency. And we also are looking at a couple of profitability measures. So the profitability measures, the first one is in BE 14.8, it's the asset turnover. So we want to look at the ability to use those assets to generate sales. That's what this measure tells us. It tells us about the ability to use those assets to generate sales. So the sales are 6,750,000, and the investment in those assets, all the assets, is in this case 2.5 million. So we've got a turnover measure of 2.7. And what that tells us is for every dollar we have invested in assets, we're able to turn that into $2.7 in sales. And that's what it tells us, the ability to turn the investment in assets into sales dollars. So it's a 2.7 turnover ratio. Again, for every dollar we have in assets, we're able to turn that or generate $2.7 in sales. The next measure, again, one of these profitability measures, is what we call the return on assets. It's the return on assets. So we look at the ability to generate earnings or profits given the investment in assets. And in terms of the return, we measure the return as income plus interest because what we're saying here is interest is a non-operating expense, right? Interest is what you pay on your debt. It's not an expense that relates to the operations of the business. So the true return that comes from the business is really income plus interest. So we want to add those two numbers together, the 390 and the 60. And so when you do that, the 390 plus the 60 is the sum, or 450,000, right? 390 plus 60 is the 450. And of course, the average total assets is the 4.5 million. So we want to put that in our denominator. And now what that says is we've got a return of 10%. Right. So given a dollar in assets, we're able to generate a 10% return in the form of income plus interest. That's what that measure tells us, the ability to generate returns given a dollar invested in assets. For every dollar in assets, basically we get 14 cents in income plus interest. And that's what it tells. I'm sorry, not 14 cents, but 10 cents. For every dollar invested in assets, we are able to generate 10% or 10 cents on the dollar. 10 cents on every dollar invested in our assets. Okay, now let's go back to the analysis of the financial statements. So we looked earlier at the horizontal analysis and the vertical analysis. We're going to in the last next couple of exercises, we're going to look again at vertical analysis and horizontal analysis before we finish up with more position analysis. So in terms of the vertical analysis, so earlier we just looked at a couple of line items from the income statement in the vertical analysis we did earlier. But a complete analysis would look at the entire income statement. And that's really what they're asking us to do here in exercise 14.1. They want us to prepare an income statement and show both years and then in comparative form. So we'd have the years side by side, and we want to do a vertical analysis. So the income statement format is in the chapter, but I've presented it here for you. So this is the basic format that is in the chapter. So if I could just kind of set this up for you, the sales that were given of 4 million minus the cost of goods sold gives us our gross profit, right? And I don't necessarily like to let me actually, what might be just a little bit easier. I don't necessarily like to use brackets, but I will here just to be a little bit more consistent with what's in the book. So in this case, the sales less the cost of goods sold kind of equals the gross profit, right? So expenses are subtracted from the sale. So that's what cost of goods sold is. And then we want to add in all of these expenses, right? So we got some selling expenses and we got some admin expenses. And when you add all those expenses, oh, this is what you get, right? And now what we have to do is, in order to calculate income, it's the gross profit minus these operating expenses, right? We've got all these operating expenses and we want to subtract those operating expenses, right? They get subtracted from the gross profit. That's how you get income. So the gross profit minus those operating expenses gives us income, and then subtract that income tax expense, right? Subtract the income tax expense and we've got income. That's all I've done here. I've set it up in the format that's given to you in the chapter. And now that we have that format, well, the vertical analysis says that we should express every line item on this income statement as a percent of our sales. Sales is kind of the base amount. So remember what we did the last time. All we did was establish sales as the base and express every item as a percent of sales. So in this case, and if I could maybe just kind of shrink this down just a little bit. That's good enough. That will work. So here you kind of get the sense for what I've done here. Again, everything's going to be divided by 4 million on this income statement. Every single thing we do is going to be divided by 4 million. And what I'm going to do here is actually I'm just going to go ahead and fill in all of the percentages, and hopefully they line up properly. We'll see. Well, no, not quite. But let me see here if I can kind of fix this just a little bit. Okay, so they're not quite lining up, but actually let's just put them in separately. It might be a little bit cleaner. Okay, so I'm gonna enter each one kind of separately. 57%. And all of these, again, are calculated based on dividing the line item by sales, in this case, the 4 million. And I'll put the calculations in as well. And I'm just going to do 1 year. I'm not going to do both years because I think that's something that you obviously should be practicing on your own. You don't necessarily need me to do all the calculations for you. But I will finish off this one income statement, and then we'll kind of talk about it, and I'll let you worry about the previous year. You can practice by doing the previous year. Okay, so good enough. So again, all we're doing is we are expressing, if you will, each line item as a percent of our sales. So in this case, we know here that we want to take that 2,280,000 and divide by 4 million. That's 57% of sales. The gross profit, we want to do the same thing. We want to take that 1,720,000 and we want to divide it by sales, right? And we want to take the selling expenses, the 600,000, and we want to divide by sales. That's where that 15% comes from. That's what we're doing. And then the administrative expenses, we want to express them as a percent of sales. So we're just going to divide them by the sales number, the 4 million. And then the total operating expenses, we want to express that 1,120,000 as a percent of sales, as a percent of that 4 million. And then the last couple of things down here, that operating income, we want to make sure we express that as a percent of sales, 600,000 divided by 4 million. And then the income tax expense, we want to express that as a percent of sales, right? So 240,000 divided by 4 million. And then lastly, the bottom of the income statement, we've got the net income of 360,000, and we want to express that as a percent of our sales. So all we're doing is dividing each one of these line items by the number at the top, the sales number, and that gives us our measure, or in this case, the percent of sales for each line item. And I'm not going to do the previous year, but I'm just going to get started here. So on the previous year, the base is sales of 3.6 million. Every line item here now needs to be expressed as a percent of that $3.6 million. And the whole point of this is we want to be able to highlight changes. When you look at income statements on a side-by-side basis, right? And I'm going to put one more number in here so that I can kind of talk about the kind of comparisons that you can make when you look at statements side by side like this. So in this case, what we're saying here is that we have cost of goods sold that is actually 52% of our sales. So in terms of commenting on changes, the kind of thing that you want to look at is key changes. So you want to know in this case what's going on? Why is cost of goods sold increasing so much? In the previous year, cost of goods sold was only 52% of sales. This year, it's 57% of sales. What's going on? Why is that cost of goods sold growing quite so much as a percent of sales? And is that going to continue? And those are the kind of changes you could highlight. And you'd want to do the same thing with gross profit, with sales expenses, admin expenses, operating income, net income. You want to get some sense for what kinds of significant changes are happening from the previous year to the current year. Okay, but that's enough for you to kind of start thinking through about how you might use a vertical analysis of the income statement. Okay, so continuing on analyzing the income statement. Now we're going to, instead of a vertical analysis, do a horizontal analysis. So remember, in this horizontal analysis, what we want to do is we want to look at changes over time. So we want to compare the previous year to the current year, and we want to know what's the increase or decrease, and what's that as a percentage increase or decrease this year versus the previous year. So we've already got the format of the income statement. We've got the current year. We've got the previous year. All we need to do is set it up so that we can calculate the amount of the increase or decrease, as well as the percent of the increase or decrease. So when we do that, so let's see, I can kind of fill that in here, I think. If we take the 2,240,000 minus the 2 million, what that tells us is that we've got an increase of $240,000, right? 2,240,000 minus 2 million is $240,000. And that, what does that represent as a percent increase? Well, you want to take that 240 and you want to divide it by the 2 million, right? The way we get a percent change is by taking the amount of the increase or decrease and dividing it by the base year, the previous year, in this case, the 2 million. And we want to do the same thing with cost of goods sold. We need to be able to measure the amount of the increase or decrease in that cost of goods sold. So the 1,925,000, we want to subtract, if you will, the 1,750,000. Right? That's what we're gonna do here. We're gonna subtract that 1,750,000 from the 1,925,000. So the increase in cost of goods sold is $175,000. And what's the percentage increase in that cost of goods sold? Well, that $175,000 in this case represents a 10% increase. So what we have here is a 10% increase. That's what it actually represents. It represents a 10% increase. That 175,000 divided by 1,750,000 is a 10% increase. So let's see if I can't go ahead and fill in the increases here for the other line items. So the gross profit, that 315,000, right, minus the 250 is $65,000. And also the next line item, the selling expenses, the 152.5 minus the 125. Well, that's a $27,500 increase. And then the admin expenses, that is an $18,000 increase. So altogether, when we look at those total operating expenses, they've gone from 225 to 270,500. That's a $45,500 increase in those operating expenses. And operating income, well, operating income, that has increased as well, 44,000, 25,000. minus the 44,500 minus 25,000 is 19,500. And then the income tax expense, well, we can see that that's increased as well. And what this tells us here is that we've actually got a $7,800 increase in income tax expense. And when you look at the effect that that has on net income, right? 26,700 minus 15,000. Well, that is an $11,700 increase in our net income. And of course, we want to express all these line items as a percent, right? I mean, it's useful to know that we've got a $65,000 increase in gross profit, but that is 26% above last year, right? That's what that tells us. And we do the same thing for, in this case, these selling expenses, right? We want to know what that $27,500 increase represents. It's a 22% increase. And then we also want to be able to consider the admin expenses. Admin expenses are up, right? They've increased $18,000, and that's 18%. That's an 18% increase. And then when we look at, in this case, the total operating expenses, well, the total operating expenses are up 20%. That 45,500 is a 20% increase. And then when we look at operating income, well, operating income in this case has gone from 19,000 from 35,000 to 44,500. That's a $19,500 increase. So that's 78%. All right, that's a 78% increase in our operating income. And then when you look at the income tax expense, well, that's kind of a an appropriate increase given the increase in our operating income. We're seeing here taxes have also increased. In this case, 7,800. Take that 7,800 divided by the 10,000. That's what you get, a 78% increase. And then lastly, that $11,700 increase in net income, that is in this case, it is, and I have the, yep, 11,700 divided by the 15,000 is a 78% increase in that net income. So we get some sense for, again, what things are happening when we look at changes in these line items. So what kinds of conclusions can we draw? Well, this is pretty significant. Income is up 78% versus last year, right? We've got a 78% increase in income, but we've only got a 12% increase in sales. So, if I were managing this business, I'd want to know what's driving that, How do you get a 78% increase in income when your sales are only up 12%, right? Your sales are only up 12%, but you've got a 78% increase in income. So you want to focus on those kinds of things. Cost of goods sold is not growing quite as fast, right? Cost of goods sold, sales are up 12%, cost of goods sold is only up 10%. And that's the kind of thing that, if you were managing the business, you'd want to look for. You'd want your sales growing faster than your expenses, right? If your sales are growing faster than your cost of goods sold, that's going to contribute significantly to the gross profit. And that's why you're seeing a 26% growth in your gross profit. Those are the kinds of things you look at. Cost of goods sold is the largest expense on the income statement, right? 1,902,500 in the current year, 1,075,000 in the previous year. So to the extent you can minimize the growth in cost of goods sold, you're able to see increases in your income, in your gross profit and in your income, because that sales growth is translating to growth in the bottom line, the income. Okay, so that's enough on horizontal analysis and vertical analysis. So we've looked at both the income statement from a vertical analysis standpoint and a horizontal analysis standpoint. So let's go back. I guess this is the last one that we're going to do is position analysis. we're going to go back and look at liquidity. And when we look at liquidity, the key measures again are going to be the current ratio and the quick ratio. So we need to, in this case, measure the current ratio. And again, the current ratio very simply is current assets over current liabilities. So what are the current assets? So let me just highlight those again. The current assets are going to be the cash and cash equivalents all the way down to those prepaid expenses. Those are the current assets, right? Current assets are there. And the liabilities, well, we got two this time. The liabilities, I'll kind of box those in. The liabilities are here, right? Are the short-term obligations and the accounts payable. Those are the liabilities. So with that in mind, we can calculate in this case that current ratio, and I've summarized the numbers down here. So if you add all five of those current assets, right, the cash, the investments, the accounts and notes receivable, the inventories, and the prepaid expenses, those are the current assets, 17,645. Current liabilities, you got to add those two together. Those are the current liabilities. So when we put all those together in this calculation, right, we can measure that current ratio, at least in the current year. So in the current year, current assets are 17,645, and those current liabilities are, in this case, the 2461. So this number, 17,645, and the liabilities of 2461. That's how we measure the current ratio. And what that is actually is 0.9. So what that tells us is they do not have enough in current assets to meet their current liabilities, right? There's not enough available, which indicates a weakness, right? What's indicated here is they've got some significant weaknesses related, in this case, to their ability to meet those current obligations in the current year. And if we were to do the same thing for the previous year, well, I've got the measures summarized down here, the numbers, if you will, the 21,893 of assets and the 22,138 of current liabilities. So if we do the previous year, if I put those up here, we have the 21,893, and we have this 22,183. Put that there, and if we round to one decimal, so you can at least get some sense here. This measure actually comes out to be 0.99, and when we round it to one decimal, it goes up to 1.0. So it's 0.99, and when we round to one decimal, it's just at one. So you can see they're really struggling, right? They in fact, if you don't round that number, you can really see that they don't have enough, right? They don't have enough in current assets to meet their current obligations, and it's getting worse, right? It's not getting better, it's getting worse. So you can draw those kinds of conclusions when you compare to a prior period. Now, if we also want to be able to measure the quick ratio, well, then we need to be able to exclude those assets that are not quick assets that we can't quickly liquidate. And there are two of them here. So the inventories, right? That's not a quick asset. It takes a while to sell off inventory. Prepaid expenses, well, there's no ready market for prepaid expenses. So it's almost impossible to liquidate prepaid expenses. So if we want to measure quick assets, we got to take those two out of there. Got to remove the inventories, got to remove the prepaids, because those are not quick assets. So when we do that, when we measure those quick assets, then we just need the cash, the investments, and the accounts and notes receivable. The liabilities don't change, but the quick assets now represent only those assets that we can quickly liquidate. So if we measure the quick ratio using, again, these quick assets, then what we have here is the 13,560. and we want to divide by the 20,461, right? 13,560 and 20,461. So what that actually tells us here is it's 0.7. So again, they don't have enough quick assets. If they didn't have enough current assets, well, certainly there are not going to be enough quick assets to pay their current liabilities. And the previous year, well, we can use the quick assets and the current liabilities to measure these variables in the previous year. So 18,132, and we want to put that over 22,138. And the previous year, it was 0.8. So yeah, it's getting worse. It's not getting better, it's getting worse. So the current ratio tells us that their performance is getting worse in terms of the ability to pay those current liabilities. And the quick ratio tells us the same thing. It's getting worse in terms of their ability to pay those current liabilities. They don't have enough. For every dollar in liabilities here, they only have 70 cents in quick assets. For every dollar in liabilities here, they only have 80 cents in quick assets. Not enough. There's just not enough here. Okay, so that is it for the assignment for chapter 14. Don't hesitate to reach out to me should you have any questions, and hopefully this will help you get through the application assignment and the quiz for chapter 14. That's it.